Okay, let's hit it.
People in government, all the elected officials, owed us this 34 trillion. What if we said, pay us or go? Right? So if you quit paying your mortgage, what does the bank say? Pay us or go. Right? So there's no this is where the checks and balances ends. There is no checks and balances on this being debt. Debt is repaid. 34 trillion is never getting repaid, folks.
It
Not
is
only is
actually
34 trillion getting repaid, it gets prepaid all the time.
gets repaid regularly. Actually, in fact, way more than 34 trillion roll over every year. I don't have the numbers on me right now, but I think per year the federal government repays something like 100 trillion or so um, in treasury bonds and bills. So it's constantly repaid all the time, all the time. It's just when people talk about 34 trillion, they're talking about the current balance of securities outstanding. That's
And
it.
then it's important to reiterate this isn't debt in the same way that this guy's talking about like a mortgage. This is I have a security called a bond that's going to have an interest rate and it's going to mature by a certain date. And when that happens, there's somebody at the Federal Reserve that presses a button and a number moves from this balance sheet to that balance sheet. And that's it.
For at this point, is probably not even any button pressing needed anymore.
That's exactly what I was going to say next. Computer
It's
just
just a
takes care of all of
program.
it. Yeah.
Automatic autopilot thing. But yeah, this is a common thing that people say. Ooh, what happens when China calls in the loans? Right? There's no such thing. Calling in the loans. There's no loans. First of all, these are securities that come with terms and with stipulations. And when they mature, the federal government swaps them out for cash, and that's it. There's no loan. There's no.
There's no ability of the bondholder to say, I'm calling the loan due.
Right.
Yeah.
Right. No ability nor the desire on the part of the bondholder to say that. You bought the bond with specific terms, and that's what you get.
Yeah.
Right. And a trillion every 100 days is more of a sign. And, we can be angry about how it's all gone, but now it's so dire. We need to start looking at how do we defend ourselves?
Now it's, this guy's going to sell us gold, Nima. I can
Yeah,
smell
no,
it.
I mean, so I was going to say, so this has been the perma answer from gold bugs for as long as I can recall.
The
For
perma problem and the perma answer, right?
right, for since 2008, and longer, of course. But I'm just bringing up 2008 so you can sort of visualize how that has gone. How's it gone for the gold bugs compared to people who are open to diversify more, right? And I'm not saying all gold bugs are purely gold, but we have done shows on here talking about a strategy that I like, that I do apply, which is the permanent portfolio. It's a portfolio designed by Harry Brown, consists of 4 different asset classes: cash, bonds, gold, and stocks. And that's a very low volatility, long term portfolio that grows over time. And if the stock market does great, you do well. And if the others do good, then you do well. Every aspect, every asset class of the portfolio lifts the portfolio up, and they all help each other in a way. Um, so yeah, but then you're not going to do the permanent portfolio unless you understand all the stuff that we talk about here, unless you understand that these treasuries are not really debt, and stocks can also do great, as some may have noticed on occasion. So it's good to diversify. And I'm not against gold, right? I'm one of the biggest fans of gold, probably. Uh, I hold a lot of gold in my portfolio, but I don't just do it for the sake of
Because it's
holding
going to
gold.
end any second, and gold is going to be the only thing valuable
Right,
after
right.
fiat is figured out is actually worthless by everybody.
Right. Once you run out of
Yeah.
food, I'm going to eat my gold. Like, no. So yeah, it's a part of a bigger picture strategy, and it's a little more complicated, right, than just accumulating your gold back.
Yeah, and then again, we at the beginning of this, we pointed this out that this 34 trillion, whatever the number is, he goes, it's unsustainable now. Why now?
Always,
What is
always,
special about the mathematics of 34 trillion that wasn't special about 20 trillion? Like,
right.
what's
It's always this is always the moment where it's unsustainable. Is whenever the pundit is talking on TV. That's always
and is about to sell us
coincidentally.
gold? Let's see if he's going to sell us gold right now, Nima.
against what might be coming, and history shows only seems to show examples of this reserve currency rising and falling into failure. The
Let's talk
$1
about that.
trillion every 100 days is a sign that things are progressing much worse than any of the brightest minds in Washington or Wall Street were able to project. The needs growing faster than their understanding of how bad the needs are.
And them so them basically inventing $1 trillion every 100 days. How does that not lead to inflation? That has to, right?
Of course, the whole thing's been in.
Jimmy hit the nail on the head again. Why is it? I mean, he doesn't say hyperinflation, but
Right.
we're saying
So,
these huge, incredibly unrealistic numbers, and we're not seeing the world come to an end. Why not?
right.
Yeah.
So I mean, there is a point there that we've always said this on our show. Large deficits contribute to aggravated inflation levels. What we're not saying is it's going to turn into runaway hyperinflation that's uncontrollable, right? So we have predicted on our show when the COVID deficits came, we said there's probably going to be elevated inflation at higher levels, somewhere between 5 and 10% for several years to come. And that's sort of materialized. And I think now it's been slowing down over the past year or two.
And then it happened exactly the point that all the global supply chains got messed up. I'm still wondering if the global supply chains and the war, I mean, the Ukraine war, for example,
Absolutely.
is just totally screwing stuff up. I mean, this is the Peter Zahan level thing that we've been talking about from other shows. Like, look at the Strait of Hormuz, and is the Strait of Hormuz the same one as the Suez Canal?
No,
Because
Strait of Hormuz is Iran.
okay, yeah, thank you. So
Controls
the
that.
Suez Canal, the Strait of Hormuz. So in the Suez Canal, going through the Red Sea, we've already had who the Houthis? What are they called?
Yeah.
Attacking and commandeering ships, right? And there's companies going, well, shit, we're not going through the Suez Canal anymore because it's dangerous.
Yeah.
Well, what does that does to the pricing of everything?
Right. So that's part
Right.
of global supply chain systematically breaking down and the end of globalism as we know it, as we've discussed on some of our other shows.
Right.
That is happening. That's contributing to the inflation. Certainly, the stupidity of the COVID supply chain meddling obviously has made things more expensive. But that the stupidity gets injected. It causes all kinds of stuff. The prices rise, and as the prices rise, we see we look at the rate of acceleration of prices, the inflation rate,
Mhm.
right? But at one point, it reaches a level where it levels out, and that's kind of where we're at now, I think.
Well, and I think it's also important to point out we've pointed this out on the show before when it comes to creating new money and how that causes inflation. Yes, there's a connection there. However, as long as there's still stuff to buy, if there's still capacity to fill out, you're not really
Yeah.
going to see it. In the same sense that, okay, there's a grocery store and there's 100 items on the shelf. Let's say it just sells one thing for the sake of the simple argument. And the community only has enough money to buy half the items off the shelf. If you keep introducing money into the community and they can continue buying what's left on the shelf, the prices aren't going to go up until everything's gone off the shelf. If you start introducing more money, now you're having more money competing for the same amount of resources, right? So unemployment is indicative of a resource that's not being fully utilized, which is literally labor. And the fact that you still have unemployment I understand it's more complicated than this, but the fact that you still have unemployment is kind of the base level
I'm
indicator.
trying to share a chart while you talk.
What's that? Oh,
I'm trying to share a chart to
let me
illustrate.
maximize that chart. There we go. Yeah. So if there's still unemployment, not enough money has been spent into the system to purchase everybody's labor. Right? So as
Yeah.
long as there's still unemployment, more again, I'm totally oversimplifying this and kind of acting like the money just kind of falls into an ocean. I mean, there's spikes and weird stuff all over the welfare and stuff that makes this complicated. But in general, as long as there's unemployment, you can still spend into the system without really recognizing any inflation due to spending.
Yeah.
Right?
So
There's
that
other reasons that can cause inflation, but due to creating money, you shouldn't see any inflation. That much
yeah,
inflation. Yeah.
yeah. So we're seeing here that U.S. industry capacity utilization has fallen below 80 again. So this downtrend here is a major headwind for any inflation trends, right? It keeps inflation subdued, and also as we saw here, obviously when the lockdown started, it went as low as almost 60, below 65 actually. And so yeah, you can drop a bunch of money into the system. It's going to go into capacity utilization to some extent, and so that reduces the inflation shock. And on the other hand, however, in the case of COVID, there's so much capacity was destroyed or made inefficient that we did see. Obviously, we've been seeing some inflation over those years. And then also another aspect of this is, of course, how is the new money spent, right? Is it spent on building new bridges, facilities, roads,
Infrastructure.
or
Yeah.
infrastructure, or is it spent on Apple iPhones and cases and new gadgets?
Or
That,
PPP loans that go straight to owners to stick straight in their savings account so they can
yeah,
buy a yacht,
yeah. So,
right?
um, in the case of the COVID money, a lot of it was just thrown around to facilitate consumer spending. And in fact, Tim Cook of Apple said as much. He said, we're reporting record profits thanks in part to the government's support, the support money that was
The PPP
dished
loans and
out
such.
during the
Yeah.
lockdowns. Um, so, and then of course, war spending is very inflationary. You're injecting money to destroy things in the real world, and then also spending on military in general is very specialized. You have to hire very specialized, very rare engineering skilled people and stuff like
Right.
that to build
And you're
the
putting money into the
shit.
system and taking resources out of it.
Well, yeah,
Right.
you're adding money, and you're not putting new consumable resources into the system.
Well, you're not
Anytime
putting
that kind of
consumable
spending,
resources or capital, right?
yeah,
Like it's
anytime
you're just taking stuff out of the private sector that the private sector doesn't get to use at all.
anytime that kind of spending happens, government deficit spending, export surpluses, and private investment spending. These are all types of spending that that add more money to the system, but do not add new consumable resources into the system. In fact, in the case of export surpluses, they get removed from your country. In the case of investment, people build new things, gadgets, machinery, etc., but no new consumable products come out of this. These types of spending combined together as a percentage of GDP tend to be the prime causes of inflation. Of course, there can be other stuff, political issues, wars, just the pure destruction of resources. That can always happen.
Inflation, yeah, the whole thing. It's like, we could talk about this other piece. I'll save it in the Substack. The reason, the Grand Canyon size hole, what created that in our finances. We can talk about that in a second. But yes,
there's one other thing I wanted to say about inflation. Raising interest rates causes inflation for two reasons. everybody thinks raising interest rates lowers inflation because it makes money more expensive, so more money isn't getting created. First off, that there doesn't seem to be any evidence that that's the case. But more importantly, like we just said, it's just a risk-free security, these treasury bonds. So if you increase the interest rate, you're just increasing the amount of risk-free money that you're throwing at anybody who either A, holds a treasury bond, or B, has any money in a savings account. And maybe even more importantly, you're increasing the cost of credit. So like anything, any business, capital, anything that is utilizing the cost of credit in order to get business done, it just made that more expensive, and that end price has to be passed on to the consumer. So it's just this arbitrary dial. I learned that from Mike Norman. Just this arbitrary dial that raises prices for no reason.
Yeah, I've sort of, I think I found a pretty good explanation of this relationship in a recent article that I shared with you from Discipline Funds.
Are you going to pull it up?
I have it here. Yeah, I think it may be interesting. Just look at that real quick.
Switch. There should be a button for you to switch the tab you're sharing. You still got the Fred. Oops.
Stop the screen share, and now I do share. Okay. How do higher interest rates push inflation?
Wait, hold on. Let me get it up here. There you go.
Yeah, and I'm not going to read, but people can read from that article. It's, I guess I'll share the link here somewhere. Can I share the link? Comments. Oh, we have a comment from Jesus.
Yeah, from
raising interest
from
rates.
Jesus.
From Jesus. Acts like helicopter money. Yes, that is true to some extent. I've recently sort of refined my understanding of this a little bit after I read this article and the stuff that's been going around in my head for a while. So when the Federal Reserve first raises interest rates, it's true that you don't need to. You can keep that article up so people know what we're talking about. Love Mike Norman. He gives away $1 million worth of knowledge. Yeah, he does. So, do interest rates push inflation down? I think they can, actually. He made a good argument in this article. When interest rates are first raised, a lot of asset prices come down. Bond prices come down.
Like housing pricing. Okay.
Stock prices come down. Housing prices may come down also. But more importantly, a lot of financial assets that people hold in their portfolios, like their liquid cash assets, fall in value. So that has an effect on how wealthy people feel, and that has an impact on how they spend, right? So I just want to, I'm listing all the different effects, everything that happens when the rates are raised. On the one hand, people receive more interest payments on the money in their savings account, on their short-term treasury bills. Yes, but a lot of long-term investments, bonds, stocks fall in value. So people feel, actually they don't feel, they are less wealthy to that extent that those asset prices come down. That may impel some people to cut down on spending during that specific period, right? But then also he makes the case, so the asset prices come down, and from here, it's all, the market has dialed itself into the new situation. Rates are higher, asset prices come down, but now the interest payments keep flowing in at this high rate. So there could be an initial shock, an initial disinflationary or deflationary shock from these asset prices coming down. But then the economy will basically start at a lower base with higher interest payments. And now there's actually room for inflation to start developing over the next couple of years if the rates stay elevated. And the asset devaluations have already happened, right? So now over the coming years, these higher interest payments will be more and more cause and more contribute towards inflation. Versus in the very beginning, the very first thing that happens when interest rates are raised sharply, is that asset prices immediately come down. The interest payments haven't come in yet, but the asset prices have fallen right away.
Mm.
So that can have a disinflationary effect for a little while. Now, of course, it has to be balanced against the fact that a lot of people receive more interest on their savings, on their treasury bills, etc. And then, like you said, the cost of loans effect, the income effect, of course. Right? More interest means more income to some bank accounts, to some people, and higher income allows you to borrow more. So,
I guess to your point, there's all sorts of factors. Some push
right,
it up, some push it down. It's
exactly.
complicated.
It's complicated, but you can make a case that the initial shock, yeah, it may be disinflationary, deflationary, but then over time, there's actually the stage is set for a longer term, higher levels of inflation because these interest payments keep rolling in. And on the net, then these interest payments, they are inflationary. But once the asset price shock has been absorbed and all that, the interest payments, because some people pay more on their loans, right? So that's the one side of things. But also, people receive more money on their savings accounts. So that whole thing is a wash. But the interest paid on treasury bonds and treasury securities is a net injection. There's no counterbalancing drain on those on that money in the economy. So that is a net injection that leads to more interest income in the economy.
Damn straight.